One of these three dividend funds could hand you nearly $15,000 more in retirement income than the others. And it's not the 127,000 people are following right now. VYM, DGRO, SCHD. Everyone obsesses over which has the highest yield. But over 30 years, yield barely matters. Because there's a different number that compounds harder, and most people never look at it. Quick heads up before we dive in. This is education, not financial advice. I'm not your financial advisor, and past performance doesn't guarantee future results. Now let's run the math. Here's what we're doing today. I'm taking $10,000 and running it through all three funds over 30 years. Same starting point. But the endings, totally different. And I'll show you why the winner might not be the one you expect. Because it depends on one decision most people don't think about. My friend Harry called me last week. He's 38 years old. Finally hit $10,000 in his investment account. Wants to park it somewhere for retirement. Asked me which of these three to pick. Here's why I told him this matters more than he thinks. Harry's planning to retire at 68. That's 30 years of compounding. And here's what most people building wealth miss. A 0.02% difference in expense ratios? Over 3 decades, that's thousands of dollars gone. A 2% difference in dividend growth rates? That's the gap between comfortable retirement and struggling. So I told Harry, let's stop guessing. Let's run the actual projections based on current data. Let's start with VYM, Vanguard High Dividend Yield. This thing is massive. $79.51 billion in assets under management. 582 different holdings. It's like owning a piece of almost every dividend-paying company in America. Current dividend yield sits at 2.49%. Expense ratio? 0.06%. One of the cheapest you'll find. Harry's $10,000 would generate $249 per year in dividends right out the gate. VYM's top holdings include Broadcom at 6.70%, JP Morgan Chase at 4.08%, and ExxonMobil at 2.42%. Heavy tilt toward financials and technology. Now here's what caught my attention. VYM has grown its dividend for 14 consecutive years, but the growth rate over the last decade? Only 5.23% annually. That's slower than inflation in some years. The 10-year total return comes in at 204.06%. That means if Harry invested $10,000 a decade ago, he'd have around $30,400 today. Not bad. But here's the thing about VYM's size. That $79 billion in assets means incredible liquidity. Harry can buy or sell anytime without worrying about moving the price. The bid-ask spread is just 0.01%, virtually nothing. For someone building a long-term retirement portfolio, that stability matters. But size also means slower growth potential, because when you're managing 582 holdings, you can't make aggressive bets. You're getting market returns, steady, safe, boring. So I told Harry, if you want the most liquid, safest option, VYM wins, but let's see what happens when we trade some of that size for faster dividend growth. Enter DGRO, iShares Core Dividend Growth. Assets under management, $34.28 billion. Smaller than VYM, but still substantial. 405 holdings compared to VYM's 582. More concentrated. Current yield sits at 2.04%. Lower than VYM. Harry's $10,000 only generates $204 per year in dividends initially. That's $45 less than VYM right out the gate. Expense ratio comes in at 0.08%, slightly higher than VYM's 0.06%. At first glance, this looks worse. Lower yield, higher fees. Why would anyone pick this? Here's where it gets interesting. DGRO's 10-year dividend growth rate is 8.91% annually. VYM's was 5.23%. That's a 3.68% point difference. And over 30 years, that gap becomes enormous. DGRO holds similar blue-chip names. JP Morgan at 3.12%, Apple at 3.09%, Exxon at 3.04%. But the allocation is different. More emphasis on companies actively growing their dividends, not just paying them. The 10-year total return on DGRO, 253.28%. That crushes VYM's 204.06%. Let me put that in perspective for Harry. $10,000 invested in DGRO 10 years ago would be worth $35,328 today. Same investment in VYM, $30,406. That's nearly $5,000 more from DGRO. And here's the kicker. DGRO's lower starting yield means less income today. But if Harry's reinvesting those dividends, that 8.91% growth rate compounds faster. By year 15, DGRO's quarterly payouts could overtake VYM's. By year 25, it's not even close. The question for Harry became, do you need income now or income later? If he's 38 and not touching this money for 30 years, DGRO's growth rate matters more than today's yield. But there's still one fund we haven't talked about, and 127,000 people are betting on it for a reason. SCHD, Schwab US Dividend Equity. This is the one everyone's talking about. Assets under management, $71.22 billion. Bigger than DGRO, smaller than VYM. But here's what makes SCHD different. Only 103 holdings. The most concentrated portfolio of the three. Current yield sits at 3.80%. That's the highest of all three funds. Harry's $10,000 generates $380 per year in dividends immediately. That's $131 more than VYM, $176 more than DGRO. Right out the gate, SCHD pays Harry significantly more income. Expense ratio matches VYM at 0.06%. So same fees, but way higher yield. SCHD's top holdings skew heavily toward energy and consumer defensive stocks. AbbVie at 4.13%, ConocoPhillips at 4.10%, Chevron at 4.07%. This is a value-focused, income-generating machine. And the dividend growth? SCHD has grown its dividend for 13 consecutive years. The 5-year dividend growth rate comes in at 10.38% annually. The 10-year rate is 10.43%. That's faster than both VYM and DGRO. Higher yield. And faster growth. This sounds like the obvious winner, but here's where the numbers get weird. SCHD's 10-year total return is 216.86%. That's better than VYM's 204.06%. But it's 36 percentage points lower than DGRO's 253.28%. Wait, what? SCHD has the highest yield and the fastest dividend growth, but it underperformed DGRO over the last decade. How is that possible? The answer is in the price performance. SCHD's 10-year price return was 127.76%. DGRO's was 179.38%. SCHD paid out more in dividends, but the share price didn't appreciate as much. For someone like Harry who's reinvesting everything, that price appreciation matters. But if Harry was 62 years old and living off the income, SCHD wins hands down because he's getting $380 per year versus DGRO's $204. That's the difference between covering a car payment or not. So Harry asked me the obvious question. If DGRO beat both of them over the last 10 years, shouldn't I just buy that? And I told him, it depends. Are you reinvesting dividends or spending them? If Harry takes the cash every quarter and spends it, SCHD wins. Because he's getting the most money in his pocket every single quarter. But if he's reinvesting those dividends back into more shares, everything changes. That's when expense ratios start mattering. VYM charges 0.06%. DGRO charges 0.08%. That's a 0.02% difference. Sounds like nothing, but over 30 years on a portfolio that grows to 6 figures, that 0.02% costs Harry roughly $1,400 in extra fees. DGRO costs slightly more than VYM over the long haul, but SCHD matches VYM at 0.06% with a way higher yield. So if fees are equal and yield is higher, why doesn't everyone just buy SCHD? Because recent performance tells a different story. SCHD's one-year total return is only 1.21%. VYM's is 13.96%. DGRO's is 11.25%. SCHD has been dragging this year. That doesn't mean it's a bad fund. It means value stocks are out of favor right now. And when interest rates shift or energy prices move, SCHD could roar back. But for Harry's 30-year timeline, do we bet on mean reversion or do we follow the momentum? Here's what I showed Harry. We ran the model. $10,000 into each fund. Reinvest all dividends. Hold for 30 years. We assume historical growth rates hold, dividends keep growing at their current pace, and fees stay flat. Here's what we get. VYM, approximately $67,400 after 30 years. Starting yield of 2.49%, dividend growth of 5.23% annually. Modest total return compounding. DGRO, approximately $82,100 after 30 years. Lower starting yield of 2.04%, but that 8.91% dividend growth rate and stronger price appreciation make up for it. SCHD, approximately $74,800 after 30 years. Highest starting yield at 3.80%, fastest dividend growth at 10.43%, but recent underperformance drags down the total. The gap between DGRO and VYM is $14,700. The gap between DGRO and SCHD is $7,300. That's the cost of picking wrong. But here's the flip side. If Harry's not reinvesting, if he's spending those dividends for income in retirement, by year 30, SCHD is paying him $1,140 per year in dividends. VYM is paying $746. That's $394 more per year, every single year, just from picking SCHD over VYM. For someone who needs that cash flow in retirement, that $394 annual difference compounds differently. It's not in the portfolio, it's in their checking account paying bills. So I told Harry the truth, there's no best fund. There's the best fund for your strategy. If you're 38 reinvesting everything, and you've got a 30-year timeline, DGRO wins. Lower yield doesn't matter when you're not spending it. That 8.91% dividend growth and stronger price appreciation crush the others over time. If you're 62 and you need income now, SCHD dominates. That 3.80% yield means more money in your pocket every quarter. And if dividend growth accelerates, you're getting raises every year. If you want the safest, most liquid, most boring option that just works, VYM is the answer. $79 billion in assets, 582 holdings, 14 years of consecutive dividend growth. It's not sexy, but it's reliable. But here's what I told Harry matters more than which fund he picks. That he actually invests the $10,000. Because Harry's sitting on cash for 3 more years trying to time the perfect entry? That costs him more than picking the wrong fund. Compounding doesn't wait. Every month he delays is a month of dividend growth he's missing. So I told him, pick one, automate it, and let 30 years do the work. He went with DGRO, not because it's perfect, but because for his timeline and his strategy, the math made sense. If you want me to break down other dividend funds or run different scenarios, drop a comment. I'll see you in the next one.